Okay.
Yeah, good morning, Eric.
Today we discuss about bank.
Yeah.
So do you know what's bank? Yeah, first question.
Yeah, I know that this seems like a very simple question, but if we say the understanding of bank is not that simple, yep. To me, bank is like the intermediaries, and then some people deposit money, and then they can lend out the money. Yep.
Yeah. Then why? Okay. The second question is what bank provide us? What is the value bank provide us?
Oh, yeah, they provide us with uh, the the credit, which is like we can buy something, for example, house, cars, those expensive things, and then we borrow money and buy so that we can pay in we can pay by installments. And beside this also they provide values of uh, those um, transactions, which is like if I want to buy something from another guys, I can uh, use bank as an intermediaries to pay the money uh, on behalf of me.
You means transfer money to them,
Yeah, transfer.
bank
Yeah.
transfer, right?
Mm, yeah.
And okay, for the first value you mentioned just now, have you ever borrowed money from bank?
Borrow money from bank. Yeah, for me, I have no mortgage or car installment. And for the PTPTN loan, it seems like from the government, but
Yeah,
I'm not sure whether it's related to the bank. I'm not sure.
I think it's no. Yeah, government support you.
Mm. Yep.
Mm. So can you say that you didn't fully utilize the value the bank provide you?
Mm. Yeah. For this point, yeah, I haven't I haven't used
Mm.
any like borrowings.
But bank charges interest.
Mm.
And for example, you borrow money to buy car, you borrow money to buy maybe luxury goods using
Yeah.
the personal loans, interest
Mm.
rate, credit card loan,
Yeah.
the interest rate can be very, very high.
Mm.
Yeah. A few weeks ago, I checked about the interest rate of the personal loans in Malaysia.
Mm.
The flat rate is around 7 to 8%.
Wow.
The flat rate. So that means let's say you borrow 1 year and
Mm.
10K,
Yeah.
and then so you need to total pay additional 800, 700 to 800 to the bank, and you
Mm.
pay by installment month by month. So
Mm.
this is a flat rate. And if you borrow three years, so 700 to 800 times 3 years, this is the total interest, and then including your principal split over the period you pay month by month. And
Mm.
this is a flat rate. And because you see, you are not borrow money at the beginning of the years, and then you don't need to pay the money. And at the end of the year, of the end of the 3 years, you pay the full amount to the bank, right?
Mm.
So in between, you need to contribute you need to take out some of your cash flow to pay to the bank.
Mm.
So that we call this a flat rate. So the actual rate, quote unquote actual rate, in the technical term is called effective rate, is even higher, and up to like 14, 15%. Mm.
Mm.
Yeah. And this is personal loans. And in Singapore, the personal loan, the flat rate is around 3.5%. Yeah. And then the effective rate is around 6.5 to 7%. And this is personal loan. And for credit card loans, most of the country, okay, I'm not sure for other country. For Malaysia and Singapore, it seems quite similar. It's around 15% to 20%. Yeah, it's very, very expensive. And the interest rate is very, very high. Does it make you start to think? Yeah, bank borrow money. Bank lend you money to you. You borrow money from bank.
Yep.
You see, this is one of the value they provide you. But is it really provide you the value? Or actually like kind of like exploit your future value?
Yep.
And mortgage and maybe the do you know actually you can like if you invest in stock, let's say you can borrow money from the investment bank, from the brokering company, and this is the investment bank, and you can borrow some of your money and then use your assets, use your stock, use your cash as a collateral. You can borrow some of money and then make investment, and the interest rate is actually very, very low. I'm not sure what's the interest rate in Malaysia, but in Singapore it seems like very, very low. This is like less than 0.5% per year. Yeah, but if the value of your collateral drop, and you'll get a margin call, and if you cannot top up the money, they'll sell all your assets to recover, to get back their loans. So you see here, collateral really important. So like the mortgage loan, housing loan, and yeah, because you put your house, you put your property as a collateral, so that you can get a relatively lower interest rate. And unlike the car is a depreciated asset, so no much value on the collateral. But at least still has some value. So the interest rate would be lesser than credit card loans, and also the personal loans, the unsecured loan. Yeah. And what if you have some money put inside the bank, and then maybe this is a different account, but at the same bank or even different bank? What if you don't pay the money, you don't pay the installment? What the bank will do?
Yeah, firstly, it's like to confiscate your collateral, right? Like cars or your house.
Can they do that?
For cars, yeah, because I heard some people say if you don't pay the installment of car, and they can assign somebody to tow your car away, right?
It comes to your location, right, and take your car.
Yeah.
And how about house?
House. Yeah, I don't know, but I think they can also do similar ways, which is like maybe ask you out, and then in Malaysia we call lelong, right? To kind of
we call the lelong house. So they can, and actually it written in the contract, right? The borrowing and lending contract between you and the bank. So if you don't pay them money, and they can take all your thing, all your other thing, even though you use a house as a collateral, and you don't pay the money, and then your collateral value is so low, and they can try to take your other asset to recover their loss. This written in the contract.
Yeah.
And for me, this is something like, this is so bad for poor people, but it's so good for rich people. Wouldn't it be like that?
Yeah, but I think they still provide value. It is just poor people. They got a higher cost for that.
Yeah, they get a higher cost. And if you keep paying the higher cost, and yeah, I see. And yeah, mathematically proven. No further explanation anymore.
Yeah.
And okay, and also about the transferring. Yeah, this one I totally agree. And financial intermediaries, and they allow us to do the transfers and allow us to send the money, and we can deposit the money, so we don't need to store the money of our money under our mattress. Yeah, so the financial intermediaries, they act as a custodial custodial organization. They can like help us to kind of like keep our money, to keep our asset. Like if you have a lot of gold, you can go to the bank and you say, help me put into the bank vault, and I pay you some money. Yeah. And but this is not only what the bank can do. Yeah, many of the fintech are rising, and they can do the same thing. And for example, PayPal, Visa, MasterCard, and a lot of, for example, Touch and Go wallet. Yeah, any kind of e-wallet. Even though crypto exchange, they can act like the function.
Yeah.
So it doesn't necessarily need a bank to do this thing. And sometimes bank is less efficient. Yeah. And all these kind of fintech seems like more efficient. And like the international transfer, I would say most of people still use bank to do the international transfer, but more and more people don't use the wire transfer anymore, and then don't use the bank service to do the international transfer, because the foreign exchange rate is so unbearable. And then they use some other services from fintech company, for example, Wise, TransferWise, and you got a lot of them. For example, the Revolut, yeah, you got tons and tons of them. And their foreign exchange rate, it seems like more favorable, and their speed is faster. So yeah, this is kind of like they compete the market with the bank. And then yeah, so okay, I agree the bank provide us value. But it seems like their status, their oligopoly and their monopoly status, like being threatened. This is my viewpoint. And more people realize that they actually don't need bank. Yeah, even though they still need a bank account. But they kind of like less and less using the bank services. Okay, and talk about like the bank operation. Since we use the banks, yeah, even though you don't think you are using a bank every time, but you actually using a bank every single second, because you store your money in the banks, right? This is store of value, and like the custodies is also one of the use and one of the value the banks provide you. So you're actually using the product bank provide you every single second. Yeah. And you store your money in the bank, but do you really know how the bank function? Yeah. How bank use your money? Why bank can take your money and then give you some interest rate, maybe not much, and then how about the security? Is it safe? Will my saving gone? Will bank take all my saving? Why you trust the bank? Yeah, tell me some of your thoughts on that.
Yeah, for that, the first time I feel, which is surprise, is when I was in the college, in the class of economics, and yeah, we learned that our money we put our money into the bank, which is deposit, and then they can lend out our money, and not only that, actually the money that's created by the bank is like many times than our deposit, because this is something called reserve requirement, is it? Yeah, they don't have to keep all of our money. Let's say we put $100, they can like keep $10
Okay.
as their reserve. They lend out 90.
Yeah, in economics, the technical term is called the bank reserve rate or bank reserve ratio. It is set by the central bank. Okay, to be clear, we have some types of banks. First, central bank. Okay, from the bottom to the top, we got commercial bank, investment bank, and then
savings.
Another what?
Savings is the same as commercial right now, right?
Yeah.
Okay.
And an upper layer, which is central banks. And then you got another upper layer, yeah, which is maybe called the BIS. Yeah, like the full name, if I'm not wrong, is like Bank of International Settlements. Yeah, but most of us have no idea about this. Yeah, and
is it belong to a particular country?
Okay, you can think that it's a central bank of the central bank. But you don't need to know. You don't need to know this. Yeah, for our today's topic, we can just focus about the commercial banks or investment bank and the central bank. And the bank reserve rate is set by the central bank. And the commercial bank need to fulfill it. So, for example, if let's say the bank reserve ratio is 10%, so that means every money, every deposit bank receive from the depositor, commercial bank are required to put 10% of the money to the account that registers in the central bank. So, for example, Citibank, there is a Citibank account in the central bank. Just like you have an account at the public bank. So they need to put 10%. But try to imagine you and me. I put in $100. Okay. And then I want to borrow money. I borrow money from bank. Yeah, and then okay, let's say, for example, let's say I borrow money from bank, let's say $1,000. Yeah, sorry, let us use $100. And okay, $100 I borrow money from bank, and then the $100 I take from bank, then I pay you because I need to use the money to pay you something. Right? And then I pay you, and then I transfer to you the $100, and then so your $100 is in the bank. So bank just need to save 10% into the central bank account. But where the 100 come from? The 100 is a bank lend me. Yeah, but where the 100 come from?
Yeah. This
And
is
then,
how they create the money, right?
yeah, and then when 10% put in the central bank, and then okay, now you got 90, you got 90 in your bank, right?
Yeah.
And then now you decided to borrow some money, some more money, and then now you take out all your money, you take out all your $90. Yeah, let's say you take out all your $90 and then you borrow money again. Yeah, or maybe you take out sorry, yeah, it's regardless, no matter you take out money or no matter you don't take out money, it doesn't change anything. Okay, let's say you don't take out the money, you still have $90 inside your bank, and then now you borrow another additional money. Let's say you also borrow 100. Now inside your bank you got 190. Yeah, 190, and then yeah, you transfer the 100 back to me. Now I have 100. Okay, then bank take 10%, take another 10%, put inside the central bank. Yeah. So does it seem like nothing changed? But actually more money.
Yeah. Yeah.
Yeah. Because initially you don't have money in your bank account. I also don't have money in my bank account.
Yeah.
Yeah. But now you have 90 in your bank account. I also have 90 in my bank account. But I owe I owe commercial bank 100, and you also owe commercial bank 100, and you need to pay the money. Yeah.
Yeah.
And then the bank, right? The bank, now you got 90, I also got 90. Now if the bank decided to lend money to others, so they take our money and then give the money to another person. Yeah, and then when another person save the money inside the bank, and then they just need to like save another 10% on the central bank. So that means the all
create again.
all of the total liabilities, which is the depositors' money. If you look at the bank balance sheet, if the bank reserve ratio rate is 10%, a bank reserve rate is 10%. So that means banks are required to save all the depositors' money, 10% of the depositor money in the bank, and the remaining 90%, bank can keep using, keep circulating. It can borrow money. It can lend money to others.
Becomes a loan, right?
Yeah. So that you can see that. Yeah, it keep multiply. Yeah. And let's say for example, for 10% bank reserve rate, and it can, I mean the infinite value, bank can lend out. We want additional $100. If you do the calculation, you can see it's actually 200. So every 100 comes in with a bank reserve rate 10%, bank actually can borrow out. Eventually, the total value that the bank can borrow out is 200. What if the reserve rate cut from 10% to 5%? Yeah, so from $100 to become 400. Yeah, every 100, bank can borrow out $400. Now it's 5%. How about it's 1%? Bank reserve ratio rate 1%. Every $100, bank can borrow out
I think 10% already 10 times, right? If I didn't get it wrong.
10%. Yeah. So yeah, 10% is 10 times. Sorry.
Mm.
10% 10 times, and 5% is 20 times. 10%. Yes. Yeah. 5%. Yeah. If I was not mistaken, 5% is like 20 times.
Mm.
Yeah. Yeah. And
And
of course,
1% is 100 times, is it?
Yeah, 1% 100 times. But
Oh.
most of country, and we don't go under, we don't go to 1%, and most of the country like keep at the 5%, or a little bit below 5%, or a little bit higher 5%. Yeah. And but many of the countries, many of the central bank don't have the bank reserve ratio rate of 10%. This is too high. Yeah. And so that you can see how bank operate, the bank, how bank make money. They take the deposit of money, and then they do something called, technical term is called liquidity or maturity transformation. Yeah, in layman terms is they take your short term like to bank is liabilities, right?
Yep.
Yeah.
Yeah.
They take your money. That means they take the short-term liability, because you can take away your money every time as you wish, and then they use the money and lend to some people, which is long-term, and then they can charge the interest rate mismatch here. So for example, bank just need to give you 1% interest rate, and then they can lend out the money at 3%. Of course, it's a longer term. So that means bank can profit 2%. So this 2%, the 2% of the profit got risk. What is a risk? It's a liquidity risk. If suddenly all of the people take out the money, and then bank cannot pay your money, then bank will go bankrupt.
Yeah.
So this is the only risk the bank need to suffer.
Yeah.
But you can say, yeah, if the pool is too huge, if huge enough, so bank can kind of like manage the risk to earn a profit, right? Yeah, I totally agree. But how about the another side? What if the people who borrow money from bank, of the corporation borrow money from bank, cannot pay back the money fully?
Yeah, this is also the risk to the bank, right?
This is a credit risk to the bank, right? And if you understand the bank reserve rate, the concept, and you can come out the fact that the bank liability always greater than equity. Does it make sense to you?
Liability greater than equity. I don't get it.
Okay, the first is the first logic here. Why bank need to borrow money from you in order to lend money to other people?
Yeah, because one side, our deposit is the liability, then they can make the loan. So it make it balance. They need to have the deposit first at the liability side, so
why
they can
don't they
make loan.
why don't they use their own money? They don't need to pay you the interest, right? They can earn full of the profits.
Their own money.
The shareholder money, which is the equity.
Oh, is it because of? I think there are two reasons. First is like, they also need to use their money, and second is, maybe add up together is not that much enough.
Yeah, it's not enough.
Mm.
Yeah, you look at the bank balance sheet. You can go, yeah, spend hours and hours and hours, day and days, and you look at all the bank financial statement you can find. Commercial bank, you try to see, is any bank their liability less than the equity? Not possible, totally not possible. Yeah, because they get money from you and then lend out to other people. They don't, yeah, they use their own equity, invest in a lot of facility, invest in infrastructure, buy the land and building, all of these things, and apply the license and do all the things, and then they can become the bank. And then when they become a bank, they can accept depositors' money. Yeah, and then you can try to see the ratio or see the gaps between their equity and their liabilities. And some bank maybe 10 times, some bank maybe 20 times, some bank maybe 25 times. Yeah, the liability always greater than the equities. Yeah, and so, and also the another side, which is the asset. Yeah, okay, go back to the liability side first.
Yeah.
And also another reason is because of the bank reserve rate, right? Yeah. It's kind of like bank create the money by itself, and then the bank stay inside the bank account, stay inside the consumer bank account, and this is all in the liability side, right? And you say what you owe the bank, this is at the asset side. Yeah. So for like just now our example, initially, both of us don't have money inside the bank, and then I borrow money from bank. I got 90 at the bank, and then I transfer to you. So now your bank account got 90. My bank account turns from 0 to 90 and turns from 90 back to 0. And then you borrow another 100. You borrow another 100, and then you transfer all the money to me. Yeah, you transfer money to me. And then now my bank account got hundreds, right? Got hundreds. And then so this is a liabilities, right? Because both of us can take out the money every time. Yeah, you can take out your $100, I can take out my $100.
Yeah.
And then so if we take out the $100, and then bank can take back the 10% of the reserve from the central bank. Yeah. And then bank need to find a way to finance the $200 to allow us to take back. But because our borrowing, I borrow 100 and you borrow 100 from bank.
Yeah.
There's a terms. We don't need to pay it. We don't need to pay it soon. We just need to pay it maybe after 1 year, after 2 years. But how can a bank finance the 200 back to you and me? It seems like bank create money by themselves.
Yeah.
But now the bank need to finance the money, give you. Although you still owe bank money, but this is maybe 1 year later or 2 year later thing. So you see the liability in this case, it seems like initially is 0. Yeah, but it can increase, But can the equity increase? Cannot. And also the asset can also increase. Yeah, because the asset and liabilities match together.
Yeah.
Yeah.
That is loan, right? In the asset.
Yeah, of course. And here we simplify the case. We didn't take the profit, which is the interest rate. the bank earn from us.
Yeah.
Yeah. So you see, the liability can keep increasing, and the asset keep increasing.
Yeah.
And your equity remain unchanged because it's a shareholder money, investor money. And what's the problem? The problem comes to the asset side. There's a credit risk to the bank. What if you and me don't pay back money to bank?
Yeah.
Yeah. And the bank got a lot of depositors, right? And then what if he borrow out the money and then maybe the wealthy guy or the corporation, they go bankrupt and then cannot pay back your money back to bank. So what happened?
Yep. So the asset actually
Need
reduce,
to
right?
impair, right? Need to be impaired, right? Or need to be written off.
Yep. Become bad debt.
Mm.
Yeah. So how are
Yeah.
they going to fix to fix it?
How? Cannot be fixed, right?
Yep. Because
Cannot
they
be
can
fixed by their
borrow
own.
money, but it's not become asset, right? They can borrow from liquidity from the central bank, but that is not the asset. That is the liability also.
I mean, so it cannot be fixed by their own.
Yep.
They can borrow money from other bank. A bank also require the bank A to pay back the money. How the bank A going to pay back the money to bank B? I mean the commercial bank. Yeah, it's not possible because the money you lend out already gone, like you throw into the sea already become zero. The value becomes zero, assuming there's no collateral or assuming the value of collateral is worth zero. You just can't pay back the deposited money. Yeah, and so that you can borrow money from bank B or you can finance from your investor, from the shareholder. Yeah, you can get the fresh money comes in to fix a problem that but you didn't. But actually, it actually means that, okay, let's say you borrow money from bank B, you still need to pay back, right? And this is kind of like you borrow money from the bank and spend on the luxury goods. Yeah, or you borrow money from bank and throw the money into the sea. You still need to pay the money back to the bank. It doesn't solve the problem. The problem comes from the value. The value of the asset of the bank have gone.
Yes.
Yeah. Yeah. And so what should happen is all the deposited money will like cut. Will like cut half, maybe like cut some of the percentage to compensate the losses of the bank. Right.
Yeah, but how do they cut the deposit money?
I mean, okay, it actually occurred in many countries, and a lot of times, we seen it a lot of time already. In a lot of countries happens, and the bank say that, or the central bank say that in all the bank accounts, if you own like maybe 1 million, above 1 million in your bank account, okay, we will take some percentage of your money take out. For example, let's say your bank account got like 2 million, and I say if your bank account above 1 million, and then the extra part we will cut half. What does it mean? That now you have 2 million in your bank account, but it turns to 1.5 million. Yeah.
Oh, do you mean that the money that the depositor can
money.
take out?
Yeah.
Oh.
Depositor lose money. The depositor lose money, and you can try to search a lot of news, a lot of this kind of case happen around the world. And also another method is all the deposit cut. Yeah, cut. No matter your money inside the bank, just cut a certain percentage to compensate the loss. Yeah, and although this is not what the commercial bank do, this is central bank do, and this is when there is like a banking crisis. Yeah, and central bank like set the rules, and then all the commercial bank do the thing. And why central bank do this thing? Because central bank are not able to inject the liquidity, because not all countries are like US can do the infinite QE. Yeah. And go back to the case.
Yeah.
So, but what happened in reality? How they solve a problem? We have so many banking crises, we have so many liquidity crises. But how they solve the problem, and then why we seldom see the commercial bank fail bankruptcy, is because there is a central bank. They inject the liquidity, or they print money. They put inside the bank. Yeah, and then they put in the liquidity. Now bank, because don't have money, right? Because all the assets go with zero already, right? Or very less. And central bank take all the assets. Central bank say, never mind, I take the asset, because central bank think that it's undervalued. Yeah, it think the value can go up. Yeah, or even though let's say some of property is like the value cut half, and some of the property value goes zero, let's say assume. And if you think that the remaining half of the property will go up by a factor of 10, it's a good deal to take all the liabilities, even though half of them go to zero. You take all of the assets, sorry.
Yeah, can you rephrase? Yeah, I'm sorry.
Okay. Let's say I have a portfolio give to you.
Yeah.
Half of the property is certainly 100% going to zero.
Okay.
And the remaining half, now the value already cut half.
Okay.
Okay. But if you think the remaining half of the property is going to go up by a factor of 10, that means go up 10 times.
Yeah.
Do you think it's a good deal to buy at a face value?
10 times cut half, then.
So that means 1
times.
Yeah, times the times divided by 2. So that means 1 will become. So that means if you put in $1, you'll become $5, right? Yeah, for this portfolio, because half of them will go zero, and half of them now, although it's a cut half, that you think will go up 10 times. So the kind of like the the expected value for you is kind of like 5. So if you pay $1 and then you will get $5 in futures. It seems good deal, right?
Yes.
Yeah, central bank think like this. You can conceptualize, you can articulate the idea like this. Yeah. Yeah. So yeah, because value is subjective, central bank can say, okay, I think this value still go, this asset still go value. So you cannot restrict them to buy the assets, right? Even though some of them fail, even though 90% of them fail. As long as you give enough time, the property will go up by a factor of 10, by a factor of hundreds. You can give them 100 years, you can give them 200 years, they don't mind. You can give them 1,000 years. Yeah, eventually they will break even. And eventually the face value on the balance sheet will look so little, right? Because they can expand their balance sheet. They can expand their broad money. And then it make the initial asset at the central bank, which is initially is the asset of the commercial bank, need to be written off. This is even though this asset cannot be recovered, the full amount cannot be recovered. It is something like bad debt already. But try to imagine now your balance sheet got 100, 100, your asset got 100, your liability got 100. 50% of your asset need to be written off. This is serious, right? Because 50%. Why if you can expand your asset and your liability by a factor of 10? Now your asset got 1,000. Now your liability got 1,000, and only 50 of your asset need to be written off. Yeah. And central bank can keep doing this, right? Because they print the money, they can create the money, and they can do this infinitely. Yeah. So they can keep injecting the liquidity for the commercial bank. Okay, see, commercial bank don't have liquidity. Central bank say, okay, central bank, you don't have liquidity, right? If you don't have liquidity, you are going to bankrupt, right? Okay, how about I buy the assets from you, and then I give you the money. So now the assets become mine, become my assets, and then you have no problem anymore. You don't need to write off all the assets because you get the fresh money. So when there's a banking crisis, when there's a liquidity crisis, you will transfer the unproductive assets from commercial bank to the central bank balance sheet. So in short, it becomes the government, or it becomes a country problem. So the central bank and the government keep accumulating the problems and a lot of things inside the balance sheet, a lot of unproductive assets inside the balance sheet, and what they are going to do. Yeah, if they don't expand their balance sheet, if they don't run the inflation rate high, and then make the economy grow, nominal economy grow, GDP grow, and then so the value of our money keep reducing, the price of everything keep increasing. But because the loans don't have inflation, there's a contract there. It's not going to inflate. So everything inflates. The unproductive assets that should be written off will not inflate. So the percentage will change. So the balance sheet can expand. So at the end, the unproductive assets, the value, that means the face value of the unproductive assets is so low. That kind of like everyone can pay. Just like if you want to be a trillionaire, you go to the Zimbabwe, you go to the Venezuela, you can become a trillionaire. You can become a multi-trillionaire. And try to imagine, because there's a part, right? All of them don't become trillionaire overnight. They have banking crisis problem in the past, and the central bank also do the same trick. And some of the unproductive assets should be written off with like maybe a billion, just worth billion. But now everyone in the country is a trillionaire. Do the billion worth unproductive assets sit in the central bank balance sheet? Importance, significance, no. Yeah. But of course, the central bank do all these things. They have their own reasons because they want to maintain the financial stabilities. They want to prevent something bad happen. But if you look at in nature, the commercial bank, first liability always greater than equity. So that means the commercial bank cannot finance themselves if there's something bad happens. And bad thing will always happen, just sooner or later. And every time crisis comes, commercial bank need help. Yeah. So this is how our current banking industry work. And of course you can say, commercial bank can buy insurance, right? But do insurance fix a problem?
Yeah, do those insurance company have enough money to cover if, let's say, the crisis really happened?
Okay, how do they finance the money?
Insurance company, they collect
insurance.
Yeah, premiums.
Yeah, how much a premium they can collect? 100% of the deposited money value. 100% of the sum insured amount. You are working in your father company is also involved insurance, right? Insurance industry, right?
Yeah.
Do the insurance company charge you 100% of the money of the sum insured amount?
Not, of course.
Yeah, why?
Yeah, because they also use I forgot the term, the law of big numbers or what?
Yeah, law of big number. They kind of like manage the risk. They think they can manage the risk. And how much they charge? Maybe 10%, maybe 5%. Yeah, and for car, maybe you can apply this law of large number. But when the bank fail, one bank fail will lead to another bank fail. Yeah, domino effect. Yeah. And how much insurance premium you can charge? And also, maybe the more insurance premium you charge, you increase the risk the bank feel. Right?
Yeah.
Can you charge 40% of on the sum insured amount, and then bank will suddenly go bankrupt? Yeah. So if insurance company they collect insurance premium at a fraction of the deposited money, how are they going to pay back the money if the bank fail? If the assets on the bank balance sheet need to be written off? We are talking about billions and billions, right?
Yeah.
Yeah. It's not going to work. Yeah. You still need central bank comes in. Central bank still need to come in to save the insurance company.
Yeah.
Just like try to imagine a car insurance company, okay, and try to imagine half of the car go accident. Will the car insurance company go bankrupt?
Yeah, they will face a big problem there.
Maybe don't need half of the car. Yeah, just need maybe, I think maybe 10% or 20% just enough. Because you try to look at the ratio or the percentage of the between the insurance premium you pay and the potential what's it called, the insurance compensation you can get from an insurance company. You can see the ratio, right?
Yeah.
So if the insurance company, they need to remain profitable, right? They need to manage this ratio, right?
Yeah.
So you can see, if let's say you pay $1 and then you can get $100 back if something bad happens. So this is 1%. So this means the insurance company charge you the rate, charge you the rate. One for 100, they can remain profitable, right? Yeah. But what if? So does it also mean that they manage the risk? They assume only 1% of the accident will happen.
Yeah. Also, they
or less than 1% because they need to remain profitable.
Yep.
What if above 1%? They lose money. Yeah. So here we are talking about a few percentage, and you look at the car insurance is kind of like 10 times or what, right? And if you look at maybe the medical cost can even higher, can even like 20 times or 25 times or even 50 times. Yeah. And if you look at the lifetime, yeah, who will not get sick? Yeah, if all of us adopt unhealthy diets.
Yeah.
Yeah. Okay, so come back to the bank. Insurance is not going to save them. Central bank can save them.
Yeah.
Yeah. So I think I have answered the question. What if banks go bankruptcy? Right. Yeah. So this is how our you can say this is a fiat system. You can also say this is a fractional reserve system. The bank fractional reserve system. How they work. So they backed by nothing but trust only.
Yeah.
But is it because backed by nothing, so they can do this kind of trick? If it had to back by something, and they have to keep the ratio to kind of like restrict themselves, not oversupply the money, not overproduce the debt. They cannot lend out so many money. Yeah.
So it will limit the growth of the economy, right? For example, I want to buy a house, then if they don't have so much money to lend, then maybe I couldn't buy. Or maybe a company want to borrow money from the bank to expand. Maybe they couldn't.
I think this is another topic already, which is what is economic growth. Yeah, this is totally another topic. Yeah, if you say whether it will restrict the growth, if in terms of GDP, definitely. But what is the definition of economic growth? Yeah, this is another topic, totally another topic. And if you say it will restrict the GDP growth, I will agree, totally agree, because it's mathematics. Yeah, this is mathematics. But if you say economic, yeah, and we need to look into deeper. What is economic? Yeah, whether GDP is a good indicator of economic growth, it can be debated. Yeah. So what I want to say is you cannot say it will restrict the economic growth, but you can say it will restrict the GDP growth. But if you say it will restrict the GDP growth, I will ask you, what does it mean? What GDP growth means? And also, this is another topic. Yeah, it can be another topic also. What is GDP? And how GDP work? What is the formula? How to calculate the GDP? Yeah, and yeah, so I think this is yeah, I think one more last thing. And now, because now we know that the Russia and Ukraine, they are in a war, right? And Russia banking system now is suck. Yeah, and also their currency value fall a lot. Like from few months ago, from 0.013 dropped to 0.009999. Yeah, something like that. So it dropped more than like 20+% or 30%. Yeah, because they declined the war, and then they got a lot of financial sanction from the US, from the I think
EU.
US, from EU. Yeah, and from all around the investors, because they want to take our money. They don't want to put their money in the ruby. Yeah, and then the banking system is suck. You cannot do the international transfer to another country if you are Russian. If you are Russians in Russia, because they like the US, they don't allow you to use a SWIFT, which is like which is a tool to doing the international transfer, as the wire transfer. And how the banking system will become. And also, if you try to read some news, if you try to type something on Google, Russia banks, you can see government doing capital control. They don't allow you to take out the money from bank. Yeah, government put the law. Pass a law, and commercial bank follow. So commercial bank don't allow you to take out money. Yeah. All the ATM machine shut down. And you go to bank counter, the bank customer service tell that you cannot withdraw money because we have this kind of law. Yeah. So I mean, we get a value from a bank, but we also need to be aware that what we are risking on. Even though you may think the risk is very, very little, but just like the black swan event. Yeah. So I mean, in the fiat system, everyone need to be a financial analyst. Everyone need to be a financial expert to really understand about the risk. If you want to ensure your wealth can be stored, can be kept, and you need to analyze, you need to think, you need to aware the risk, and then you need to allocate your risk. Maybe you don't put all your money in your local bank account. You need to find some way to get another to get to register another bank account in another country that your local government cannot confiscate. Yeah, if you really want to be safe, really safe, this is something you have to do.
Yeah.
But do any of us have the ability to do? No. Yeah. So we are relying on somebody, and we are trusting somebody.
Yeah.
And we think
we are vulnerable, right?
They are so vulnerable. They are so vulnerable. And yeah, so this is all thing I want to mention here.
Yep. And actually, today what surprised me is that initially I thought the insurance company is very powerful. Yeah, but the discussion with you, which is we consider the premium that they charge and how much money they're going to pay if something happened. Yeah, we can see that insurance company is very weak, right?
They are also very vulnerable.
Yep. Yeah, it seems like it's just the central bank put somebody to reduce some of their burden. They drag somebody in to involve. Yeah, but still, they have to help the insurance company.
Yeah, I mean, when the big banking crisis, when the big liquidity crisis comes, central bank have to step in. If there's only like a small crisis, like maybe just a small crisis, then insurance company can pay, and insurance company still can remain profitable. And why do you think insurance company want to involve in this kind of business? Okay, we have kind of like the Basel law, Basel rules, right? We got the Basel 2, Basel 1, Basel 3, and then it's something like the control, the reserve control and control the commercial bank, and also like commercial bank also need to get insured on their like the deposit money, or something like that, and it's kind of like the depositors. If your money is below, in Malaysia, it's like below 250,000, you will be safe, because if there's something happen, and insurance will pay you the money. Okay, but here say insurance will pay you the money. This is when small thing happens, but when big thing happen, insurance is not going to pay you the money because they are going to bankrupt. And central bank will step in and pay you the money. And okay, in this case, central bank will nationalize the insurance company, and then still do the operation. But now they can sorry, not central bank nationalize. Central bank cannot nationalize company. Government can nationalize a company, and government can kind of like raise the money. You can think like raise the money from taxation, or maybe like issue the bond, issue a treasury, and then ask the investor to buy. If investor don't want to buy, it can ask his country central bank to buy the bonds, to buy the treasury. This is another thing. And so this means government, your country will do anything not allowed to prevent the insurance company fail when the big crisis comes. So and in this case, why do you think insurance company willing to take the business? You see, if this is an unprofitable business, insurance company will not take the business, right? Because there's something called agency problem, and also bankers are also an agent. They can keep lending money. They can earn commission, right? And also directors. even though the shareholder don't worry, you know why? Because they know too big to fail. So they don't worry. They know government will save it. Central bank will save it. Yeah. And yeah, even the shareholder don't worry already. Yeah. Then the director, the manager, the staff, should they worry? Yeah, they just try their best to earn as much profit as they can.
Yeah.
And it applying to the insurance company. They try their best to earn as much commission as possible. And whether the shareholder of the insurance company worry? No, they don't worry. Yeah, so you can see this is the what make all of this, like the kind of like I don't know how to use a proper term to describe all of these, like the crack. Yeah. The root cause of problem is a fractional reserve system. And then the root cause of the root cause is you have a money that can be inflated infinitely. Because if you have a hard money, you cannot do fractional reserve system.
Yep.
And also, but if you have a weak money, if you have a loose money, but if all around the world, all the country, all the government, all the central bank, they don't want to outrun, they don't want to outcompete with others to print the money, to boost the economic growth, to purchase a lot of resources, scarce resources, to kind of like exploit other people honesty, exploit other people integrity. Everyone behave very, very good, very, very honestly. Everyone have a very high level and very high standard of integrity, ethic, and they all have a good intentions, and they have a strict law. Go under the all director, manager, all the staff. They cannot behave like that.
Yeah.
We can have a soft money. Yeah. And even though you can have a fractional reserve system, but it's not that fraction as today we seen. Yeah. So in this case, central bank don't need to save the commercial bank to save the insurance company. The free market still kind of like still efficient. We don't need to introduce central bank to manipulate the market. But how difficult it can be, I totally have no idea. Because we are human. Game theory always that wins.
Yep.
Yeah. So anything want to add in?
No. Yeah.
Okay. So talk to you tomorrow.
Okay, talk to you tomorrow. Goodbye.
Goodbye.